Welcome back, everyone. Today, we're jumping right into Section 5 of our ASC 230 Cash Flows Training Explainer. In our last session together, we did a really deep dive into investing and financing activities, looking at the nuances around business acquisitions and lease splits. Well, today, we're taking that a step further. We are zeroing in on the actual mechanics of making those classification decisions. Because, let's be honest, getting this wrong carries some serious restatement risks, and we definitely want to avoid those. Now, you might be wondering, how exactly do you classify the unclassifiable? Because as we all know, accounting in the real world isn't always perfectly neat. Transactions don't always fit into perfect little boxes. So what happens when an everyday business transaction is just a complex hybrid? If it doesn't clearly belong in operating, investing, or financing, what do? If you just guess, you're opening the door to an audit adjustment or worse, a full restatement. We need a rock-solid, bulletproof framework to figure out these borderline situations. So here's our roadmap for this explainer. We'll start with the classification hierarchy, look at the big three categories, navigate those borderline items, and then wrap up with gross versus net presentation. Let's kick things off with Section 1, the classification hierarchy. I want you to think of this hierarchy as kind of like a giant sorting hat for your cash flow statement. Every single cash flow, no exceptions, has to pass through these 4 specific gates, and you absolutely must start at Step 1 and work your way down. Okay, so Step 1, is there specific ASC 230 guidance for the item? If yes, you follow it blindly. Boom, done. But if no, you move to Step 2. Is it a principal business activity? If it is, it's operating. If it's not, you slide down to Step 3. Does it involve a long-term asset or investment? That's going to point you right to investing. And finally, Step 4, does it change debt or equity? If yes, that lands it securely in financing. You've got to respect this exact order to get the right answer. Moving right along to Section 2, the big 3 categories. Okay, let's dive into this operating activities table. When we run standard, everyday transactions through that hierarchy we just talked about, most of them fall really neatly into these buckets. Now, a lot of this is going to feel super intuitive. Cash from customers, payments to suppliers and employees, right? Those are your core operating outflows. But keep an eye on the nuances. For instance, advance payments from customers, those are still operating. And what about hedge swap settlements? Well, because they're economically equivalent to interest, they land securely in operating, regardless of how the hedge is actually designated. Oh, and equity investee distributions? Those are operating too, up to your cumulative share of earnings. Before we move on, I need to point out a massive default rule. You know interest paid? Well, while it does have a financing alternative if you formally elect it, its absolute, unarguable default classification under ASC 230 is operating. Whatever route you ultimately choose, you have to be consistent, but you can literally never forget that operating is the default. All right, let's shift over to investing activities. Purchasing PP&E, always investing. That includes equipment deposits, by the way. But pay close attention to the sale of PP&E. You've got to place the full cash proceeds right here in the investing bucket. And what that means in practice is you have to actively strip any resulting gain out of your operating section. Otherwise, you're double counting the benefit, and we definitely don't want that. Also, if you acquire a business, that cash outflow needs to be presented net of the cash and cash equivalents you acquired, and it does include transaction costs. Now, what's really interesting about this slide is a major hidden trap. Capitalized interest on construction. People so often misclassify this as operating. It's actually not. It directly follows the qualifying asset under ASC 83520. Because the asset you're building is an investment, the capitalized interest is an investing outflow. If you miss this, you are literally artificially inflating your operating cash flows, and auditors will absolutely catch that. Rounding out our big 3, we've got financing activities. This is where your debt proceeds and principal repayments live. But remember the golden rule here. Principal only, not the interest. And if you're dealing with a finance lease, you are facing a mandatory split. The principal portion, that lands here in financing. But the interest portion, that has to go up into operating. And here is an ironclad rule that you can take straight to the bank. Dividends paid are always financing. There's zero wiggle room here, no election available. It is literally the singular cash flow item where you have absolutely no choice in classification. It's financing. End of story. That brings us to Section 3, navigating borderline items. So we've covered the clean-cut stuff, but dealing with borderline items, that requires some heavy analytical lifting and really tight documentation. Let's run through a realistic scenario. Imagine your main distribution warehouse burns to the ground. Terrible, right? But thankfully, you're fully insured. The insurance company wires you this massive lump sum settlement, and it covers both the physical damage to the actual building and your business interruption, meaning your lost profits from being shut down. So, where on earth does that single wire transfer go on your cash flow statement? Well, you can't just take that whole lump sum and drop it into one bucket. You actually have to split those mixed insurance proceeds based on the very nature of the loss. The portion that covers your business interruption and lost profits, that is basically replacing daily operations, so it goes straight to operating. The portion meant for rebuilding the physical asset, that goes to investing. Now, if the settlement is truly, completely inseparable, like you physically cannot allocate it, only then do you default to the predominance principle, where you just categorize it by whatever loss was the main driver of the payout. And this brilliantly illustrates a much broader concept: mandatory splits. We see this all the time with equity method distributions. Up to your cumulative share of earnings, it's considered a return on your investment, so operating. But anything in excess of that is a return of your investment, which is financing. And, like we touched on a minute ago, you've got to split finance lease payments between financing for the principal and operating for the interest. Listen, treating a full finance lease payment as operating is a classic, critical pre-ASC 84 error. Do not make that mistake. Same goes for a zero coupon bond. You settle it, you've got to split the accreted interest, which is operating, away from the principal, which is financing. Now, sometimes these borderline items don't actually need a split, but their strict classification is incredibly counterintuitive. A perfect example? Tax payments on gains from asset sales. You sold an asset, so that's investing, right? Well, yes, but the actual tax payment on that gain is virtually always going to be an operating outflow. Crazy, right? Here's another one. If you pay a prepayment penalty or a debt extinguishment premium, ASU 2016-15 says that has to be classified consistently with the debt repayment itself. That makes it a financing outflow, not operating. All right, let's bring it home with Section 4, Gross versus Net Presentation. We've spent a lot of time on the where, but now let's quickly shift to the how. Before you even think about netting two numbers together to save a little space on the page, you need to hear this loud and clear. Gross presentation is the absolute default rule. ASC 230 explicitly requires that each individual cash receipt and payment be shown at its full distinct amount. You literally cannot just net cash inflows against cash outflows simply because they relate to the exact same vendor or the same broad category. It just doesn't work that way. Net presentation is actually highly, highly restricted. It is legally permitted in only 3 extremely narrow scenarios. First, short turnover items with large volume. Think credit card settlements, but only if the original maturity is 3 months or less. Second, financial institution pass-throughs like customer deposits and withdrawals. And finally, revolving credit facilities, but again, only where the individual draw maturities are 3 months or less and the activity is frequent. So the crucial point is this. Let's say you have a revolver with quarterly draws, maybe 120-day maturities. That completely fails the netting exception. Why? Because 120 days is longer than the strict 3-month rule. That means every single draw and every single repayment on that facility has to be presented gross on your statement. Doing otherwise is a blatant presentation error that auditors will flag immediately. Ultimately, knowing all these classification rules and presentation exceptions, that's really only half the battle. When you hit a borderline item, an undocumented decision is a defenseless decision. Robust documentation of your logic, tying everything directly back to the specific ASC references we've covered today, is absolutely your single best defense in an audit. Take these frameworks, apply them rigorously, and document your steps. Which really leaves us with one big question. How many unexamined, borderline misclassifications are lurking in your own cash flow statements right now? Food for thought. That wraps up our classification guide. You are now perfectly primed for our next explainer, where we'll step completely outside the body of the statement to master non-cash disclosures and supplemental requirements. See you there.